LVMH stock crash explained. Too many brands, spin-off rumors and struggling divisions. LVMH. The luxury giant faces a stock market downturn, an overwhelming number of acquisitions and struggling brands, leading to speculation about a potential IPO or spin-off. LVMH's current financial landscape. While the financial health of LVMH appears robust, the real issue lies in its unwieldy portfolio of 75 brands, which hampers effective management. The company's stock has seen a significant decline, and Bernard Arnault, the 76-year-old CEO, has remained notably quiet amidst these challenges. What insights do analysts have to offer? In the boardrooms of Bernard Arnault, there is a search for the ideal strategy to navigate the current turmoil facing LVMH. The executive, who has built his empire on the back of the luxury sector's explosive growth during a time of increasing global wealth, is now grappling with what could be the most challenging period in his 36-year leadership. As the personal luxury goods market, valued at €364 billion, experiences a swift downturn, competitors like Hermès, known for its iconic Birkin bags, and company financier Richemont, the owner of Cartier, have demonstrated greater resilience, highlighting LVMH's vulnerabilities. Short-term outlook. The outlook for LVMH does not seem promising in the near future. Insiders, investors, and market analysts have pointed out ongoing issues with brands such as Dior and the Moët Hennessy division, alongside whispers of troubles at the flagship Louis Vuitton. Some experts attribute these challenges to the very nature of LVMH's extensive acquisitions, leading to Arnault being dubbed the wolf in Cashmere. This vast collection of over 75 brands has made the company cumbersome and difficult to steer, while the absence of a clear succession plan is causing unease among investors. In light of these challenges, analysts and insiders are advocating for potential spin-offs, such as the wines and spirits division or smaller brands, or even an IPO for non-core assets like Sephora. Stock performance. Since the start of the year, LVMH stock has plummeted by 25%, nearly halving from its peak in April 2023, resulting in a staggering loss of approximately €221 billion in market value. The company has fallen out of the top 3 most significant stocks in Europe and is no longer the most valuable French company, a title now ironically held by Hermès, a brand Arnault once attempted to acquire discreetly. Just a year ago, Arnault topped the Bloomberg Billionaires Index, becoming the first individual outside North America and the only consumer mogul to reach such heights, with a net worth peaking at $231 billion in March 2024, surpassing both Elon Musk and Jeff Bezos. However, following the decline of LVMH shares, his wealth has dwindled to around $150 billion. Despite these setbacks, LVMH's financial foundation remains solid. The debt-to-equity ratio improved to approximately 13% last year, down from 20% in 2021, and the operating cash flow reached €10.5 billion in 2024, marking a more than 25% increase from the previous year. Additionally, the Arnault family, which held 49% of the company's capital and 65% of the voting rights at the end of last year, has been actively purchasing shares during the stock's sharp decline. Potential spin-offs. Given the group's vast and diverse structure, some analysts are suggesting the possibility of spin-offs or partial divestments, with the wines and spirits division being the primary candidate. In recent years, Moët Hennessy has seen its profit margins shrink due to decreased demand, excess inventory, and missteps in pricing strategy. The division has shifted from generating around €1 billion in cash in 2019 to consuming approximately €1.5 billion in 2024. Analysts, including Luca Salca from Amber, argue that the wines and spirits division should be divested, as it has become less relevant compared to the rest of the group. They note that it currently generates profits that are more than 10 times lower than those from fashion and leather goods, operating under a different logic that relies heavily on wholesale distribution and limited innovation. Furthermore, the presence of alcohol-related brands may deter investors focused on ESG criteria, hindering LVMH's quest for absolute blue chip status enjoyed by other luxury brands. Experts from Amber propose 2 potential paths: a spin-off that distributes shares of the wines and spirits division to shareholders, similar to Richemont's approach with tobacco, or a direct sale of the majority stake to Diageo, which already owns 34% of Moët Hennessy. The spin-off would allow for maintaining French ownership and avoid selling at depressed sales volumes, while the sale to Diageo could be quicker but would involve complexities regarding pricing and the risk of losing control over a historic asset. Diageo's challenges. Diageo itself is facing its own set of challenges. Recently, the company decided to replace CEO Deborah Crew after 2 tumultuous years that undermined its strategy to encourage consumers to opt for premium products. Since Crew took the helm in June 2023, Diageo's shares have plummeted by 43%, coinciding with Johnnie Walker's abandonment of long-standing sales targets and a profit warning amid trade tensions initiated by former U.S. President Donald Trump. Smaller fashion houses at risk. Smaller fashion brands deemed less strategic and less profitable may also be on the chopping block as they continue to consume managerial resources. The recent closure of the 24S marketplace and the sale of underperforming brands like Off-White and Stella McCartney are indicative of this trend. Sephora. To spin off or not? The global cosmetics powerhouse Sephora is also under scrutiny. Analyst Erwin Ramberg from HSBC suggests that Sephora, which may not be essential to LVMH's core business, could be reconsidered in the long run. He argues that its business model diverges significantly from that of luxury fashion houses, focusing more on retail management with lower margins and operational practices, akin to mass distribution, rather than haute couture. Interestingly, there have been rumors that Sephora was evaluated for a potential listing in Amsterdam back in 2021. However, opinions among analysts vary. Luca Sacca from Amber believes that separating Sephora would not be wise due to the synergies it shares with the perfumes and cosmetics division. Legal troubles. Loro Piana and Dior. Arnault's challenges extend into the legal realm as well. A Milan court has placed Loro Piana under special surveillance for a year due to allegations of labor exploitation, claiming the company failed to prevent subcontractors from exploiting migrant workers. Prosecutors allege that in some Italian factories, working hours exceeded legal limits, employees were forced to sleep on production floors, and wages fell below the Italian legal minimum. Loro Piana has acknowledged the court's notification and pledged full cooperation with authorities, stating that it severed ties with the implicated supplier within 24 hours of being informed. Similarly, Dior faced issues in Italy last year, when some of its subcontractors were accused of exploiting undocumented workers to cut costs. Although the brand resolved the situation last month, it did not escape the negative publicity that ensued. The succession dilemma. Amidst these operational challenges, a significant concern looms over LVMH. Succession. Compared to Giorgio Armani, who recently turned 90, Arnault at 70 still appears youthful. At this year's annual general meeting, Arnault was granted an extension of the age limit for the CEO position from 80 to 85 years. Unlike other family-run businesses, Arnault has successfully involved his children, Delphine, Antoine, Alexander, Frederick and Jean in the company, even managing to mask some internal disagreements. With his children still in their formative years, Arnault appointed Stéphane Bianchi as his deputy last year. Bianchi, who has been with the company since 2018, assured shareholders at the annual meeting that LVMH has medium-term succession plans in place to address any unforeseen events. LVMH stock ownership explained chart decreasing why private firms hold 49% and what the 3% dip signals. Last week's 3.1% drop in the stock price of LVMH moat Hennessy Louis Vuitton, Société Européenne IPOs, likely left private companies with significant investments feeling quite disheartened. Key insights. The substantial stake held by private companies in LVMH moat Hennessy Louis Vuitton Société Européenne suggests that these entities have a considerable influence over the company's management and strategic direction. Notably, 2 investors collectively own a majority share of 50% in the company. Institutional investors account for 18% of the ownership in LVMH moat Hennessy Louis Vuitton Société Européenne source. https://simplyws/stocks/fr/consumer durables/amc/LVMH moat Hennessy Louis Vuitton shares/ownership. This technology could potentially revolutionize computing. Explore the 20 stocks that are paving the way for quantum computing to become a reality. Source. https://simplywall st/discover/investing-ideas/282/quantum-computing-stocks/global. To truly grasp who holds the reins at LVMH Moët Hennessy Louis Vuitton, Société Européenne IPAMC, it is essential to delve into the company's ownership structure. The largest segment of ownership belongs to private companies, which hold 49% of the shares. This means that this group stands to gain the most from any potential upside, but they also bear the brunt of the downside risks. As the market capitalization dipped to €236 billion last week, private companies likely experience the steepest losses compared to other shareholder groups. Let's take a deeper look at what the various types of shareholders reveal about LVMH Moët Hennessy Louis Vuitton Société Européenne. For our latest analysis on LVMH Moët Hennessy Louis Vuitton Société Européenne, click here source. https://simplywall st//fr/consumer-durables/epmc/lvmh-moët-hennessy-louis-vuitton Société shares. What does institutional ownership indicate about LVMH Moët Hennessy Louis Vuitton Société Européenne? Institutions often benchmark their performance against market indices when reporting to their investors, which can lead to increased enthusiasm for a stock once it is included in a major index. It is common for growing companies to have some institutional presence in their ownership. LVMH Moët Hennessy Louis Vuitton Société Européenne does indeed have institutional investors, who hold a significant portion of the company's shares. This can be a sign of credibility within the investment community. However, it is wise to approach the validation that comes from institutional ownership with caution, as these investors can also make mistakes. When multiple institutions invest in a stock, there is a risk of a crowded trade. If the trade turns unfavorable, many investors may rush to sell their shares, which can exacerbate losses, especially in companies lacking a solid growth history. You can review LVMH Moët Hennessy Louis Vuitton Société Européenne's historical earnings and revenue data below. But remember, there is always more to the narrative. Interestingly, hedge funds do not hold a significant stake in LVMH Moët Hennessy Louis Vuitton Société Européenne. The largest shareholder is Financière Gage Société Anonyme, which owns 48% of the outstanding shares. The second and third largest shareholders hold 2.5% and 2.1% of the shares, respectively. A closer examination of the shareholder registry reveals that two of the top shareholders possess a substantial amount of ownership in the company, thanks to their combined 50% stake. Investigating institutional ownership can be a useful method for assessing and filtering a stock's anticipated performance. This can also be complemented by analyzing the sentiments of financial analysts. A number of analysts cover this stock, making it relatively easy to explore growth forecasts. Insider ownership of LVMH Moët Hennessy Louis Vuitton Société Européenne. The definition of an insider can vary, but board members are generally considered insiders. Ultimately, management is accountable to the board. It is not unusual for managers to also serve as executive board members, particularly if they are founders or the CEO. Insider ownership is often viewed positively, as it can suggest that the board's interests align with those of other shareholders. However, there are instances where too much power may be concentrated within this group. Our data indicates that insiders of LVMH Moët Hennessy Louis Vuitton, Société Européenne own less than 1% of the company. However, they might have indirect interests through a corporate structure that we have not identified. Given the company's size, it is not expected for insiders to hold a large percentage of the stock. Collectively, they own shares worth €1.1 billion. In such cases, it can be particularly interesting to observe whether insiders are buying or selling shares. Source: https://smplyws/stock/afars/consumer durables Hennessy Louis Vuitton shares/ownership. General public ownership. The general public, typically individual investors, holds a 32% stake in LVMH Moët Hennessy Louis Vuitton Société Européenne. While this level of ownership may not be sufficient to influence policy decisions directly, it can still exert a collective impact on company policies. Private company ownership. It appears that private companies own 49% of the stock in LVMH Moët Hennessy Louis Vuitton Société Européenne. These private entities may have connections to related parties. Occasionally, Insiders may have interest in a public company through a stake in a private company, rather than as individual shareholders. While it is challenging to draw broad conclusions, this is an area worth exploring further. Next steps *. Considering the various groups that own shares in a company is always beneficial. However, to gain a more comprehensive understanding of LVMH Moët Hennessy Louis Vuitton Société Européenne, we must take into account many other factors. Be aware that LVMH Moët Hennessy Louis Vuitton Société Européenne is currently displaying one warning sign in our investment analysis. Source: https://simplywall st/stock/f/consumer-durables/eph/c/lvmh-moët-hennessy-louis-vuitton-société shares that you should be aware of. Ultimately, the future holds the most significance. You can access this complimentary report on Analyst forecasts for the company. Source: https://simplywall st/stock/f/consumer-durables/eph/c/lvmh-moët-hennessy-louis-vuitton-société shares/future. Note *: the figures presented in this article are derived from data over the past 12 months, which refers to the 12-month period ending on the last date of the month indicated in the financial statement. This may not align with the figures in the full-year annual report. New AI Stock Screener and Alerts. Our innovative AI stock screener analyzes the market daily to uncover investment opportunities. Dividend powerhouses, 3% plus yield. Undervalued small caps with insider buying. High-growth tech and AI companies. Or create your own screener using over 50 metrics. Explore now for free. Source: https://simplywall st/features/stock-screener. Do you have feedback on this article? Are you concerned about the content? Feel free to reach out to us directly. Source: https://investoresse-archetype-4mcom/to/wvgm Friday #feedback_mzkzm company =LVMH%mo%C%. Alternatively, you can email us at editorialteam@simplywall.com. This article by Simplywall ST is intended for general informational purposes. We provide commentary based on historical data and analyst forecasts using an unbiased methodology. Our articles are not intended as financial advice and do not constitute a recommendation to buy or sell any stock, nor do they consider your individual objectives or financial situation. We strive to deliver long-term focused analysis driven by fundamental data. Please note that our analysis may not account for the latest price-sensitive company announcements or qualitative material. Simplywall ST does not hold any positions in the stocks mentioned. LVMH's Luxury Challenge. Navigating 2024's hurdles. LVMH is facing its toughest luxury battle yet in 2024, and the stakes couldn't be higher. As the world's largest luxury conglomerate, LVMH Moët Hennessy Louis Vuitton SE, trading as LVMHF in the US, dominates the premium market from its Paris headquarters. The group manages over 70 prestigious brands, think Louis Vuitton handbags, Dom Pérignon champagne, and Tiffany diamond jewelry, across 5 core segments: fashion and leather goods, wines and spirits, perfumes and cosmetics, watches and jewelry, and selective retailing. Their €84.7 billion revenue in 2024 tells a story of resilience. Fashion and leather goods led with €41.1 billion, while selective retailing contributed €18.3 billion. But here's where it gets controversial. Despite this massive scale, Asia, excluding Japan, represents just 27.5% of sales, challenging the narrative that LVMH is overly dependent on any single market. The company's premium pricing strategy leverages iconic brand recognition to drive exceptional profit margins and customer loyalty. A model that should be bulletproof, right? Not quite. New tariffs and unexpected market shifts are creating the perfect storm. Recent performance reveals startling cracks. LVMH shares plummeted 27.11% over the past year, while the S&P 500 climbed 13.63%. This dramatic divergence stems from reduced luxury spending in China, where sales dropped 10% in 2024, and panic over U.S. tariffs announced in April 2025. Yet early 2025 brings glimmers of hope. Louis Vuitton and Tiffany both reported double-digit growth in January, suggesting the worst might be over. But is this just a temporary rebound? Fundamentally, LVMH remains a profit powerhouse with 67.03% gross margins and 14.7 billion euros in annual free cash flow. Numbers most companies envy. Their vertical integration, controlling everything from production to flagship stores, creates an economic moat that rivals like Kering and Hermès struggle to breach. But here's the twist. Despite these strengths, LVMH trades at just 20.65x forward earnings, below its historical average, because markets fear its China exposure and tariff vulnerability. And this is the part most investors miss. Japan's double-digit growth and Tiffany's integration synergies could offset these weaknesses if managed strategically. Key risks divide market opinion like never before. 1. China's cooling luxury appetite could prolong sales declines. 2. August 2025's 30% U.S. tariffs on European imports may crush margins. 3. Premium valuation leaves zero room for earnings misses. 4. Hermès and Cartier are stealing ultra-rich customers. 5. Debt, while manageable now at 1.61x net debt/EBITDA, could bite if acquisitions misfire. The bull case? Unmatched brand portfolio, cash flow fortress, and Tiffany's unlocked potential make this dip a buying opportunity. The bear case? China's slump plus tariffs could squash the luxury rebound narrative entirely. What's your verdict? Do LVMH's iconic brands justify braving the storm? Or is this luxury titan losing its crown? Debate below, we're eager to hear which side you back.